Hello and welcome back to Econosphere, retirement. It feels light years away when you're just starting out, doesn't it? But imagine finding a way to shave a full decade off that journey, reaching your financial freedom sooner. Many people wrestle with a fundamental choice in their saving efforts, often without fully understanding the profound impact that choice can have. Today, we're diving deep into the head-to-head comparison of two powerhouses in the retirement savings world, the Roth IRA and the 401k. We're going to break down exactly how each one works, step by step. We'll use real-world numbers and a clear example to show you the potential difference they can make in building a substantial retirement fund, one that could potentially reach or exceed $1 million. My goal is to simplify these often complex topics so they actually make sense, empowering you to make informed decisions about your future. And by the end of this video, you'll see how choosing one account over the other could potentially add tens, even hundreds of thousands of dollars to your retirement nest egg. Ready to unlock the secrets to a potentially faster, more abundant retirement? Let's get started. First up, let's talk about the Roth IRA. Think of a Roth IRA like a special money container where the magic happens after you've paid your dues. Imagine you earn money, and your employer or you yourself send a piece of it to the government as taxes. The money left over, that's the money you put into your Roth IRA container. Because you've already paid taxes on this money when you eventually take it out in retirement, guess what? You won't owe a single cent in taxes on the original money you put in, or on any of the profits it has earned over the years. Not $1, not one dime is taxable. It's a totally tax-free party in retirement. You contribute your after-tax dollars to this account, and then you can invest that money inside the Roth IRA. You can typically choose from a wide range of investments like stocks, bonds, mutual funds, and exchange-traded funds, or ETFs. As these investments grow through market appreciation and dividends, that growth stays within the Roth IRA, compounding over time. The really powerful part, the part that makes so many people love the Roth IRA, is the tax-free withdrawal in retirement. When you reach age 59 and a half and have had the account for at least 5 years, any money you take out, contributions and earnings, is completely tax-free. Now, there are some rules you need to be aware of. For instance, in the year 2025, if you're under age 50, there's a limit to how much you can contribute, currently set at $7,000 per year. If you're age 50 or older, you can contribute an additional $1,000 as a catch-up contribution, bringing the total to $8,000. There are also income limitations for contributing directly to a Roth IRA. If your modified adjusted gross income is above a certain level, you might not be eligible to contribute the full amount, or any amount, directly. For single filers in 2025, this limit is $161,000. If you earn more, there are still backdoor or mega backdoor strategies to get money into a Roth structure. But that's a topic for another video. Another important rule. Generally, you shouldn't touch the investment earnings before age 59 and a half unless you meet specific exceptions, such as using up to $10,000 for a qualified first-time home purchase, or for qualified education expenses, without facing a 10% early withdrawal penalty on the earnings. However, and this is a significant point of flexibility, you can withdraw the money you originally contributed to a Roth IRA at any time, for any reason, completely tax-free and penalty-free. This can offer a valuable emergency fund aspect, though it's generally recommended to keep your retirement savings dedicated to retirement. One final, often loved feature of the Roth IRA is the absence of required minimum distributions, or RMDs, during the original owner's lifetime. Unlike many traditional retirement accounts, the government doesn't force you to start taking money out at a certain age, currently age 73. You can let the money continue to grow tax-free for as long as you live, and even pass it on to your beneficiaries who may also benefit from tax advantages. So, to sum up the Roth IRA, you pay taxes on your money up front, let it grow tax-free, and then withdraw everything in retirement completely tax-free. It offers incredible tax advantages later in life and some flexibility with accessing contributions. It's a favorite for good reason. But before we declare the Roth IRA the undisputed champion, let's examine the 401k and see what advantages it brings to the table. Now, let's shift our focus to the 401k. This is the retirement savings plan most commonly offered through employers. If the Roth IRA is about paying taxes now, the 401k is generally about postponing them. When you contribute to a traditional 401k, you're usually putting in money before it's taxed. This means your taxable income for the year is lower, potentially reducing your current income tax bill. Getting a tax break today is a big draw for many people, freeing up cash flow in the present. Here's the flip side. Since you didn't pay taxes on the money going in, you will pay taxes on it when you take it out in retirement. Every dollar you withdraw from a traditional 401k in retirement is taxed as ordinary income. So it's essentially a tax-later system. One of the most significant advantages of a 401k often comes from your employer. Many companies offer an employer match, meaning they will contribute money to your 401k based on how much you contribute. This is essentially free money. A common match might be 50% or 100% of your contributions up to a certain percentage of your salary, like 3% or 6%. If you contribute enough to get the full employer match, you're instantly boosting your retirement savings with extra funds you didn't have to earn yourself. The contribution limits for a 401k are also significantly higher than a Roth IRA. In 2025, you can contribute up to $23,000 per year if you're under age 50. If you're age 50 or older, you can contribute an additional $7,500 as a catch-up contribution, bringing the total to $30,500. These higher limits, especially when combined with an employer match, allow for very rapid wealth accumulation. 401ks are particularly attractive if you believe you are currently in a higher tax bracket than you will be in retirement. By contributing pre-tax dollars, you get a tax deduction now when it's most valuable, and pay taxes later when your income, and presumably your tax rate, might be lower. However, there are some trade-offs compared to a Roth IRA. With a 401k, your investment choices are typically limited to the options provided within your employer's specific plan. You don't have the freedom to invest in nearly anything you want, as you often do with a Roth IRA opened at a brokerage. The plan might offer a limited selection of mutual funds or ETFs. Also, like many traditional pre-tax retirement accounts, 401ks are subject to required minimum distributions, RMDs. Once you reach age 73, under current rules, you must start withdrawing a certain amount of money from your account each year, whether you need it or not, and pay income tax on those withdrawals. There are exceptions if you are still working for the employer sponsoring the plan. Early withdrawals from a 401k are generally more restrictive than with a Roth IRA. If you take money out before age 59 and a half, you'll usually face income taxes plus a 10% early withdrawal penalty, unless you qualify for a specific hardship withdrawal or take a loan, though loans have their own risks. So, in summary for the 401k, you get a tax break now by contributing pre-tax dollars, benefit from potentially generous employer contributions, can save much larger amounts annually, but you will pay taxes on your withdrawals in retirement. It's a powerful engine for building wealth, especially with an employer match. Now that we've explored both the Roth IRA and the 401k, the really exciting question is, which one actually helps you reach your retirement goals faster or leaves you with more money when you get there? To find out, let's run a realistic simulation. We'll introduce our hypothetical saver, Alex. Let's say Alex is 30 years old and earns an income of $60,000 per year. Like many diligent savers, Alex aims to save 10% of their income for retirement. That's $6,000 per year. Alex has a choice. Contribute that $6,000 to a Roth IRA, or contribute it to a traditional 401k offered by their employer. Alex wants to make the smart choice that maximizes their retirement fund over time. If Alex chooses the Roth IRA, they will contribute $6,000 of money they've already paid income taxes on. This money then grows, and all withdrawals in retirement are tax-free. If Alex chooses the traditional 401k, they will contribute $6,000 from their paycheck before taxes are taken out. This reduces Alex's current taxable income from $60,000 down to $54,000, resulting in a lower tax bill today. However, as we know, withdrawals later will be taxed as income. Here's a crucial factor for the 401k in Alex's scenario. Alex's employer offers a match. Let's assume a common employer match structure. The employer matches 50% of Alex's contributions up to 6% of Alex's salary. 6% of Alex's $60,000 salary is $3,600. Since Alex is contributing $6,000, which is 10% of salary, the employer will match 50% of that contribution up to the 6% limit. 50% of Alex's $6,000 contribution is $3,000. $3,000 is less than the $3,600 limit, 6% of salary, so the employer will contribute the full $3,000. So, with the 401k, Alex contributes $6,000, and the employer adds another $3,000. That's a total of $9,000 going into the 401k each year. With the Roth IRA, Alex contributes $6,000, and there's no employer match added to the Roth IRA itself. Though sometimes employers offer a Roth 401k option, which is different from a Roth IRA, but we're comparing a standard Roth IRA to a traditional 401k here, as is common. So, Alex is saving $6,000 annually in the Roth IRA scenario, and $9,000 annually in the 401k scenario. $6,000 from Alex, $3,000 from the employer. Alex plans to invest consistently and leave the money untouched until retirement. To make a fair comparison on how the account type affects the outcome, we'll assume Alex invests in the same types of assets in both accounts, aiming for similar growth. Let's project this out over a 30-year working career, assuming a consistent annual return on investments. Investment returns vary, of course, but for this illustration, let's assume an average annual growth rate for the investment portfolio of around 7%, considering a mix of appreciation and reinvested dividends. This is a reasonable long-term average, although actual returns will fluctuate year to year. Let's first look at the Roth IRA scenario for Alex. Alex consistently invests $6,000 each year for 30 years, totaling $180,000 in contributions over that period. This money grows tax-free at our assumed 7% annual rate, with all dividends reinvested back into the account to buy more shares, compounding the growth. After 10 years, Alex's Roth IRA balance might be around $90,000. After 20 years, it could grow to approximately $315,000. And after 30 years, right around Alex's planned retirement age, the Roth IRA balance could reach a substantial figure, potentially nearing $900,000. Let's estimate a final balance of around $898,000 after 30 years based on our assumptions. This balance represents Alex's original $180,000 in contributions, plus approximately $718,000 in tax-free investment growth and reinvested dividends. The key point here is that this entire amount, the $898,000, is Alex's to withdraw in retirement, completely tax-free. Every dollar of that growth and every dollar of those reinvested dividends escapes taxation forever. Now, let's look at Alex's 401k scenario. Remember, in this case, the total annual contribution is $9,000. $6,000 from Alex, $3,000 from the employer. This is $30,000 more saved each year compared to the Roth IRA scenario, thanks to that employer match. Alex contributes a total of $270,000 over 30 years, $9,000 per year. This larger amount is invested in the same way, growing at the same assumed 7% annual rate. Because more money is going in from day one due to the employer match, the 401k balance grows faster. After 10 years, the 401k could be around $135,000. After 20 years, it might be closer to $470,000. And after 30 years, the 401k balance could easily exceed the $1 million mark. Let's estimate a final balance of around $1,287,000. This balance includes Alex's $180,000 in contributions, the $90,000 in employer contributions, and approximately $1,009,000 in investment growth and reinvested dividends. At first glance, the 401k balance looks much higher, over $1,200,000 compared to the Roth IRA's nearly $900,000. It seems like the 401k is the clear winner, right? But wait, remember the crucial difference. The 401k is a tax-later account. When Alex starts withdrawing this money in retirement, it will be taxed as ordinary income. Let's assume that in retirement, Alex is in a 20% average tax bracket. This is just an assumption, as future tax rates are unknown and depend on many factors. If Alex withdraws the entire $1,287,000 401k balance, a 20% tax would amount to approximately $257,400. So, the after-tax amount Alex would actually get to keep from the 401k would be the total balance minus the taxes. $1,287,000 minus $257,400, which equals $1,029,600. Now, let's compare the after-tax amounts Alex gets to keep from both accounts. From the Roth IRA, $898,000, all tax-free. From the traditional 401k with employer match after taxes, $1,029,600. In this specific scenario, even after paying taxes in retirement, the 401k with a significant employer match ended up providing a larger after-tax sum, approximately $131,600 more than the Roth IRA. So does this mean a 401k with an employer match is always better? Not necessarily. This simulation highlights the powerful impact of the employer match. That additional $3,000 contributed every year to the 401k grew significantly over 30 years, and even after being taxed, it resulted in a larger final amount in Alex's pocket, compared to the Roth IRA where only Alex's $6,000 was invested. However, let's consider how the outcome could change. 1. No employer match. If Alex's employer didn't offer a match, Alex would only be contributing $6,000 per year to the 401k, just like the Roth IRA. In that case, the Roth IRA's tax-free growth and withdrawals would almost certainly result in a larger after-tax amount than a traditional 401k of the same initial contribution size, which would be fully taxable in retirement. 2. Different tax brackets. Our simulation assumed a 20% tax bracket in retirement. What if Alex ended up in a 30% tax bracket? The tax hit on the 401k would be much larger, potentially eroding the advantage gained from the employer match. Conversely, if Alex's retirement tax bracket was lower, say 10%, the 401k would look even more favorable. The key consideration is whether you expect your tax rate to be higher now, favoring the traditional 401k tax deduction, or higher in retirement, favoring the Roth IRA's tax-free withdrawals. 3. Contribution levels. The 401k allows for much higher contributions, $23,000 per year versus $7,000 for the Roth IRA in 2025. If Alex could afford to maximize contributions to a 401k, say, contributing $23,000 plus the employer match, the total accumulated wealth would be vastly higher than what's possible in a Roth IRA alone, even after accounting for taxes. For high-income earners looking to save as much as possible, the 401k's higher contribution limits are a major advantage, even if the Roth IRA's tax-free nature is appealing. Some people even choose to contribute to a 401k up to the full match and then contribute to a Roth IRA. 4. Flexibility. Remember the Roth IRA's flexibility? Alex can pull out contributions anytime without penalty. With the 401k, accessing funds before retirement is much harder and often penalized. If having access to your saved principal is a significant concern, the Roth IRA offers greater flexibility. 5. RMDs and estate planning. For those concerned about RMDs in retirement or wishing to leave a tax-free inheritance, the Roth IRA has advantages as it avoids RMDs during the owner's life and can be passed on tax-free to beneficiaries, subject to their own RMD rules. So which account is better? It's not a simple one-size-fits-all answer. The traditional 401k with an employer match is an incredibly powerful tool for building a large retirement sum quickly, especially if you believe your current tax rate is higher than it will be in retirement, or if you plan to save more than the Roth IRA limits allow. The employer match is a significant boost that is hard to pass up. It's free money. The Roth IRA is fantastic for those who believe their tax rate will be higher in retirement, value tax-free growth and withdrawals above all else, appreciate the flexibility of accessing contributions, and want to avoid RMDs. Many people find that contributing enough to their 401k to get the full employer match is the absolute priority. Don't leave free money on the table. After securing the full match, they might then prioritize contributing to a Roth IRA if they are eligible, to benefit from tax-free growth and withdrawals. For those who max out both, they might go back to contributing more to their 401k or explore other savings options. Ultimately, the best choice, or combination of choices, depends entirely on your individual circumstances, your income level now, and projected in retirement, your employer's 401k plan details and match, your need for flexibility, and your long-term financial goals. Understanding the key differences, especially the tax treatment now versus later, the impact of the employer match, and the rules around contributions and withdrawals, is the first step to making the decision that puts you on the fastest path to your financial freedom. We hope this deep dive has clarified the Roth IRA and 401k comparison for you. Making smart choices about your retirement accounts early on truly can add significant wealth to your future and potentially help you retire sooner. If you found this video helpful, please give it a thumbs up and subscribe to Econosphere for more insights into building your financial future. What are your thoughts on the Roth IRA versus the 401k? Do you prioritize one over the other? Share your experience in the comments below. Thanks for watching, and we'll see you in the next video.